we come back to the beginning where I tell you that I don't have much needs. So if I can cover my expenses, that's okay. If I will die with billions, that's good for someone else.
Which is your expected rate of return for your investments today for the following decade?
I think 4%. I mean, if you mean real, so
Real.
above inflation.
Ray Dalio had an interview, I think, a few days ago, and he says that average investor should expect 3-4% for the next decade, and he was referring in nominal terms.
Well, with inflation being at 7% right now, so we actually have been taxed. So we have been taxed. Money has an expiration date. So with money you have, you need to spend fast because they will lose power, even though they are invested. I don't know. That seems to be not sustainable in the future. I don't know. I really don't know. I still put like a pie, 3.4, 14, 15 for like funny reason as expected growth of my portfolio in nominal terms. But in Switzerland, inflation is pretty low, but still the Swiss franc to USD is kind of weird because in the last year, the Swiss franc went down compared to the US dollar, which is fun for me because I'm invested mostly in dollars. There are several aspects to take into account, but I think I'm expecting 3% per year in a nominal term in Swiss franc.
And basically, you would like to use like a glide path and increase your equity allocation if the markets, let's say, become less expensive.
Kind of, but I don't think the glide path is usually based on like your age and the closer you get to retirement age. But I want to keep using this strategy. The higher the CAPE, the lower my stocks percentage. Then on a monthly basis, I will check the global CAPE value and then readjust the percentage based on a formula and then rebalance. So essentially, I'm more than rebalancing. If I had a fixed 60-40 and then the stocks dropped, I would sell bonds and buy stocks. But now I need to sell more bonds and buy more stocks because the target would not be 60-40, but maybe 70-30 or something like that. So yes, I don't of course don't claim this to be optimal. That just makes me sleep at night.
There are many Romanians who prefer to stay in cash because they don't see that volatility on a secondary market, although they lose a lot of money in real terms. If you had a lump sum of 100,000 euros in cash today, how would you invest it, let's say, in this risky market environment, especially if you don't have any experience related to investing?
Well, I agree that like in the short term, inflation is not a huge problem. So you don't have to rush to invest. You can afford to lose 1% of the buying power of your money. I don't know what's the inflation in the European countries. I don't know.
In Europe, it's 5% and in Romania, 8%. Right? Yes, 5%.
Okay, really? Okay, and maybe I should check the data. Or maybe it's just the projection of a monthly.
And the core CPI, so that which excludes energy and food, the volatile, let's say, items, is 3%. So also above their 2% target.
Okay.
Which is surprising for Europe,
Surprising. I don't know. My view is that we won't see hyperinflation in the major currencies. Or we would be just buying weapon and ammo and canned food. That would be pretty harmful. I don't know. But at the same time, we printed a lot of money, and I don't know. I'm not a macroeconomist. I have a hard time getting my head around it. But in the short term, I still think that you can afford to not take a lot of forced risks. You need to study. Before investing the money, you need to study and study the fundamentals. Learning passive investing is easy, kind of easy. The main problem is the behavioral aspect. So you need to have an investment strategy that makes sense and that you can sustain psychologically. Exactly. And you might trust someone to invest for you, but it's usually not a good deal, especially in this low return environment. Paying 1% to 1.5% someone, it's not very funny.
Yeah.
Paying a good portion of your expected returns. So having said that, you ask me how I would invest 100,000. Well, it really depends on many factors. If you are young and if you have a very high cash flow, it really depends on many factors. Let's assume you have zero cash flow and you just got an inheritance, like a windfall. So that's your money, and you're not going to make another 100K next year. So at that point, it's like wealth management. You should like define what's your safety. How's it called? What's your emergency fund, and then decide what to do with the rest. If you are young, I would probably go 80-20, maybe. You can even buy a single Vanguard Life Strategy, 80-20, whatever. Low cost index fund, blah, blah, blah. There's no alternative. I mean, it's very hard to find an alternative.
Unfortunately, the only alternative is to do market timing, which you know that on average doesn't work well. And also emotionally doesn't work well. When you see the market declining, your last thought is to buy when you don't have experience, right?
No, and then, I mean, it's been proven that many people follow herd behaviors. So a lot of people lose money doing these things. Like if you see at the ARK-K fund, they had stellar performance with like zero capital. Then a lot of money came in and they have lost money. So almost everybody who invested in ARK-K lost money, even though if you look at their graph, they're still overperforming the market. But people lose money because they group and do herd behavior, and they all join the market when the bubble crashed. So everybody loses money. So yeah, I wouldn't do timing. Eventually, I would, to reduce volatility of the entry point, do dollar cost averaging, even though it is mathematically maybe inefficient, but I would do dollar cost averaging. Or as Nick Majuli suggests, I would maybe do strategy averaging. So maybe you enter and you do 90-10, like 90% bond and 10% stocks, and then move the money from one bucket to another. So you increase your volatility, expected volatility, but you are already all invested. I don't know. I think those are pretty similar techniques. So I would rather I have 100,000. I want to set 20,000 aside, 80,000 to be invested. I would take 2 years, and in 2 years I would invest 4,000 per month in a 80-20 strategy. So you avoid getting the psychological hit of losing 50% the day after you buy.
I think even though lump sum investing beats dollar cost averaging, I think in 2/3 of cases, in this market environment, especially for a beginner, maybe entering the market with, let's say, 1/3 of his funds, and then dollar cost averaging the rest might be a good compromise after all. And
maybe. Well, dollar cost averaging, of course, lump sum beats as expected return, but if you take the risk adjusted return, I think they should be the same. They should be almost the same, because of course, if you invest like 100,000 today, what's your wealth in a month is very volatile. If you only invested 4,000 this month, what's your wealth at the end of the month? It's pretty predictable because you have there's less volatility. So it really depends. If you don't know yourself, if you don't know how you react, you're better off trying and do a step at a time and allow yourself a couple of years before entering with your full potential.
At least psychologically, we should work better, I think, for a beginner.
Yes, I mean, maybe after 2 months you realize that the stock lost like 50% and your first 4,000 became 2,000, and then you panic and you quit, but you only lost like a portion. Or then you realize that, hey, I'm kind of excited when things go south. Okay, you're learning about yourself. I think, yes, I really think that the mechanic of passive investing is pretty simple. The psychology is very, very tough.
By the way, which is your view on cryptocurrencies or gold or other investment hedges? In Romania, I think most of the young people put their money into cryptos. Bitcoin, Ethereum. We also have a local cryptocurrency, I think Rondo, something like that. And it's shocking because they have no internal rate of return, but people are still thinking that this should offer them higher returns. Of course, not risk-adjusted returns, but higher returns than the stock market. And I'm wondering why
I
is that?
understand.
Because actually, cryptocurrencies are just volatile assets, but we don't have any expected returns for them.
I totally agree with you. I mean, my view on cryptocurrency, would take another 2 hours, and sadly, in 20 minutes, I need to leave. But to make it short, I like 90. I think I don't see like crypto as an investment. It's just speculating. It's like a casino, okay? And may actually be that the only underlying value of the crypto world is the casino itself. I mean, it's perfect to organize like a gambling website or I don't know, a real casino, a crypto casino. For the rest, I don't see. I don't see any underlying value on the cryptocurrency aspects of crypto. I think like Bitcoin is the most horrible thing humans have built, something like this. But I see some potential in the concept of smart contracts on even NFTs, but not the way they are implemented and used right now. I don't see value in that, but I see value in digital tokens that have some purposes. But I'm in that phase where I can see that there might be value, but I have no idea what kind of value. For me, it looks like in year 1999 or 2000, where with the dot-com bubble, and there is all this shit, and everything crashed, but among them there was Amazon and Google. So there might be the Amazon and the Google of this world somewhere. It's hard to find them. Probably everything is overpriced 10x, 100x. So maybe there will be some of the cryptos that will survive another 50 years. But today they are unrecognizable. But recently I've read and seen a couple of very deep analysis. The best one is the one by Moxie, the co-founder of Signal. And he said a couple of things which are, like, from the technical point of view, unappealable. Like nobody wants to run a server, and there's no real decentralization in the client apps, and protocols move way slower than platforms. Say emails are still unencrypted, while WhatsApp implemented the end-to-end encryption in 3 months. All the cryptos are just another protocol that gets out of date. It's hard to change. So another crypto is born with an improvement of the protocol. And nothing really useful came out after more than 10 years they are around. So like 95 of my view is negative. But I see that there might be something. I don't perceive it yet. I'm technologically interested. I'm also actually coding some smart contract in Solidity from the technical point of view. But as an investment, I would just stay away. Just enjoy maybe 1% of your wealth, bet on gamble on some coin. It's not an investment. And if the argument is, hey, look, Morgan Stanley added this ETF, or this broker allows you to buy, yes, because they can charge you incredibly high fee because people are stupid and they accept paying 2% fees on trading these crappy assets. So it's not a good argument if, hey, look, those shops are selling shovels for the gold diggers, so there must be gold. No, there are shovels.
By the way, speaking about gambling, if you were to choose 5 individual stocks and invest a lump sum today, which would be your choice? Or 5 individual country indices, if you
Okay, Alibaba, Meta. They have an incredibly low PA ratio for being a growth stocks. So I would say first Baba, Facebook, Meta, Coca-Cola, Sony, and I want to shield my meme stocks, which is Czech Cap Ltd. So those are the 5 stocks.
It's incredible because we haven't talked about this before, and I also own just 2 individual stocks right now, international, of course. On a local market, I own more. I own Alibaba and Facebook, Meta, and these were also the first 2 you mentioned. I mean, I don't
sell puts on Baba and Facebook. I sell cash covered puts like 10% below market price all the time. I mean, if Facebook loses another 10%, I'd be happy to buy. And I'm essentially just grabbing $100 every week here and there, selling puts. But I don't own them. I own Coca-Cola. I own Sony. Okay, those are my bets. But this is not financial advice. No study behind. I'm just being an asshole, just being a dick with my money. And so I know that passive investing is a bit boring. So I want to spend a fraction of my wealth in those kind of bets that don't really fit a strategy. But be sure, I mean, if you want to do the same, make sure that you are aware that even if you find the winners, you are not skilled. To define yourself as skilled, it takes like 20 years. There's an amazing article by Nick Maggiulli, which is why you should invest in individual stocks. And the argument is not because it's hard to beat the market, but it's hard to tell if you're skilled or not. It's an amazing article. I read it, and it takes 20 years to tell that, okay, you are skilled at picking stocks. You might be lucky for a long time. So don't be overconfident. Just...
Yeah, I think also Sven Carlin made a video recently about Facebook, and he downgraded its intrinsic value to less than, I think, $100, which was a little bit scary because he was bullish on Facebook a few months ago.
Yeah, I don't understand. People really are scared that he will stop operating in Europe. That's not gonna happen. That's not gonna happen. That's impossible. They won't find a solution.
I mean, I don't like very much, let's say, growth stocks, but for me, Alibaba and Facebook were rather on the cheap side, let's say. I mean, if you look at the valuations...
The price-to-earning ratio is 17. The price-to-earning ratio of Facebook is below the average price-to-earning ratio of the value of VTV, which is Vanguard Total Value. I mean, I also own Coca-Cola, and the price-to-earning ratio is like 27. So, okay.
Yeah.
So Facebook, I think,
earnings might be a little bit more volatile, let's say, but they also have a quite low enterprise value to EBITDA. I think it's 11 or 12 when I checked. So I don't know. I think there are a lot of emotions in the market right now, and
yes, of course. But so remember that even emotions are priced into the market, and things can be irrational for a long time. So the market, I think, is still efficient, but it's accounting for human emotion as well.
Tell us one low-cost country from Eastern Europe you would choose to fire, and why you choose it.
Okay, one country from Eastern Europe. At one point, I thought about Croatia. I don't know if it can be considered about Eastern Europe. Is it Eastern enough?
I'm not sure.
Well, I'm a Mediterranean.
To the east, you go to Russia, you know?
I mean, I'm a Mediterranean person, and all the countries I've considered has been around the Mediterranean Sea, which Portugal is not made. We can extend to Portugal, but also the south of France, the Croatia, Italy, of course. Never thought about really a country far from the sea. I mean, I'm in Zurich. I'm far from the sea, not that far. I can reach the sea in 1 hour flight. If I need to think about Eastern country, might be somewhere in Romania. I've been a few times in Timișoara. I have friends there. There was a blog. Now the blog is down. I don't know if you know the family behind What Life Could Be. They are no more active, but they had a blog very long ago. I've been there to a couple of meetups of Financial Independence Week Europe. They organized the FIWE, FIWE. And I've been like the Timisoara area for me. It looks very, very nice, very quiet. I wasn't expecting to be that beautiful. So if I had to pick one, and I'm not doing before because you are Romanian, but yeah, Timisoara. So I would say Romania, but I only know that area. So
Right. When do you think it's the right time for someone to retire early? Let's say in terms of lifestyle and happiness. And what are you planning to do in the future with all this freedom you have after retiring early?
I don't have much freedom. By the way, I think you shouldn't retire before you know how many people will be dependent on you. And I don't know what's the right age. If you are 25 and working for a huge tech firm and say, hey, I can retire in 5 years, unless you already know that you don't want to have kids, you won't have aging parents. I mean, I think you first have to define what would your family life be. Before that, you can make plans, but those plans are really useless. So I would say, I don't know, before age 40, like if at 30 you want to claim yourself retired, you have no idea. You are going to live another 60 years. You have really no idea. You cannot tell that. Okay, so I would say 40, and I would say yes. You need to know your family situation. And the second part of the question was, sorry.
What are you planning to do with all this financial freedom?
What I'm planning to do with all this freedom, I'm in the least freedom. I'm in the time in my life where I have the least amount of freedom, essentially. With 3 kids, I cannot say I want to go to a trip around the world. I cannot do anything. I have kids. My eldest daughter, she's going to start kindergarten in August, so she will have only in Switzerland. You cannot even. I mean, they have the vacation. They're like a working. They have 2 weeks of vacation every quarter, and they are fixed in that 2 weeks. So not much freedom. What I plan to do, I plan to keep working on my projects and really try to be as intentional as I can with my mentally challenging activities, essentially. And waiting until all the daughters will be old enough that I can start like traveling on my own or just with my wife again. I really miss the freedom to think amazing, huge projects like, I don't know, 3 months backpacking in Vietnam, like this. I cannot do right now, so I'm not sure I'm that free.
How much would be enough to retire early in Timisoara?
I don't know. With a family,
without family.
Without family, probably you can retire with 1,500, 2,000 per month. So if you assume a safe 3% withdrawal rate, safe kind of, you do the math back to it, 24. We should consider taxes. So let's say 30,000, 3%. We are at roughly 800,000, 900,000, less than $1 million. I think with $1 million, you should be fine.
In Timisoara, with $1 million, you are a wealthy guy.
You are a billionaire. Yes, but people have a wrong idea of what does it mean to be wealthy. Yes, if you have 1 million at disposal to spend it, you are rich everywhere. But if you need to survive the rest of your life, 1 million may not be enough. Even in a place, if there is inflation going up and you are not able to invest it properly, even 1 million goes to zero in 30 years.
That's true. My last question for today is, what advice would you offer for a young man starting financial independence journey today?
Do not focus on the goal of financial independence. Financial independence should be a side effect of what you do. So you should focus on growing a career, do the things you love, and try to make as much money out of it as possible. Be very good with managing money. So don't spend on things that don't add value to your life, but try to kick asses. I mean, you want to discover the new cure for cancer. You want to build this startup. Then after as a personal experience, after a few years, you will discover that, hey, maybe it's not worth to grinding to want to get another promotion at work. At that point, you would just turn toward your bank account and you say, oh, there is $500,000 sitting there. Okay, nice. But if you start at age 20 to plan for, oh, I should reach 1 million as soon as possible, so then I can do what I want, it will be painful. It will be painful. I was super excited to join the workforce at age 25 and go and do robotic research. Then, big disappointment. Video game development, disappointment. Google, oh come on, I'm at Google, the best place in the world. Disappointment. Then I say, okay, check, I have 1 million there. So now I can do whatever I want.
Not disappointing.
Don't just. Yes, I mean, if you, meanwhile, while you were kicking asses and grow your career, you also spent all your money saying that, but I love my career, I will never want to stop working. And then maybe life happens, your motivation goes down, or you get kids and you want to spend time with kids. Then if you turn toward your bank account and there is zero there, you have no options. So build options, but do not make building options your goal. Just try to create a great career and to do an amazing job.
Mr. Rip, it has been a pleasure to discuss with you today. And I would like to thank you very much for accepting my invitation to be with us in our investing podcast today.
It's been a pleasure.
I want to thank everyone who watched our show today. And I wish you a wealthy investment portfolio and a nice investing year, because markets look pretty expensive right now. Thank you very much and all the best. Take care and bye-bye for now.
Bye, Victor, and thank you everybody for listening. Bye.